Hello, Rebecca Steinhaus here with Remax Services. We are actually at CrossCountry Mortgage office, and I'm here with our friend Craig Stelzer.
Hello.
We're here at their beautiful office in Delray. Do you want to tell them where it's located?
1690 South Congress on the corner of Congress and Germantown.
Gorgeous office. You guys just moved in, right? A few months ago?
Yeah, it's about 6 months now.
Yeah, I went to the grand opening. It was super fun. Anyway, today we will be talking about credit scores, how that impacts you getting a loan, what loans you can work with, and the do's and do nots of during the home buying process. So, Craig, since if I don't really have the best credit score, can I still get a loan?
Yeah, so great question, Rebecca. Thank you. So we're going to dispel some bad information. I'm going to speak factually about what scores you actually need to get a loan, and also dispel some of the bad info about when people try to take their credit into their own hands, some of the common mistakes that people make, because we see it a lot. And so I'll start with CrossCountry's rules, at least, about different types of loan, because it varies from lender to lender. But generally speaking, FHA loans tend to be the most liberal with respect to credit score. CrossCountry will actually do loans down to a 530 credit score with 10% down through the FHA. Anything above 580, you need 3.5% down versus 10. Okay, so that opens up home purchase options for a lot of people, that might have thought they were not creditworthy before.
So just because you don't have the best credit doesn't mean you can't get a loan.
Nope.
Cool.
And so as long as you've got a score within those parameters and you've got the income, of course, we can make the loan. And so a lot of it depends. When you look at a credit score, there are things that go into that credit score that may or may not allow for you to buy a house. And so within that score, you'll see oftentimes collections, judgments, bankruptcies, a history of foreclosure, short sale. And each one of those, there are certain waiting periods for whatever type of financing you're doing. And so quick rule of thumb, on FHA, you need to be at least a couple of years out of a short sale, 3 years, or rather you need to be a couple of years out of a short sale or a foreclosure. They tend to be more liberal than, say, a conventional mortgage, but FHAs tend to be, you only need to be 2 years out of a bankruptcy, 3 years out of a foreclosure. You could actually be in a Chapter 13 bankruptcy, which is a payment plan, as long as you've been doing it for 12 months, and still be able to get financing.
You still can get financing.
Yeah, so FHA is where we usually look when someone maybe has some history of derogatory, tend to be an FHA borrower. Conventional mortgages, like we said a couple weeks ago, are for people that have higher credit scores, better credit history.
Those are private loans.
No, conventional mortgages are through Fannie Mae or Freddie Mac.
Oh, I always thought conventional was private.
And so conventional loans do allow, though, for a short sale after 4 years. So if you had a short sale over 4 years ago, you can get a conventional mortgage.
Gotcha.
Right. If you had a foreclosure, though, FHA makes you wait 3 years. Conventional makes you wait 7. Right. So when there's a foreclosure, it tends to go into FHA mortgages.
Gotcha.
Okay. So specifically, though, I want to talk about credit scores. And
we have a question from David Searle. How is the the refinance market, and are the credit scores required? Hold on. David Searle, hold on. Wait. How is the refinance market, and are the credit score requirements the same for a refinance purchase?
Refinance on. I think I understand the question. So if you're doing a credit score qualifying refinance.
I don't know. All right, we're getting the answer to you now.
Credit scores are required. The same credit score requirements are for conventional mortgages. On a refi versus a purchase. If you're refinancing from an FHA to an FHA, there's no credit score required. It's called a streamline. So if you're doing a rate reduction, we don't see a lot of them anymore, but there's no credit score requirement. Otherwise, the credit score and credit profile requirements are the same on a refi as a purchase.
Okay.
Does that answer your question?
I don't know.
Did we take too long? Did you log off?
I read it wrong. No, he's still there.
Oh.
I think he's asking, yeah, so the credit, how does it different? Please. All right.
I don't know what's happening. But yes, generally, credit score requirements for purchases are the same as on refinances. And credit score requirements, if you buy a home cash and want to refi right after, it's the same qualifications as a purchase. Unless you're doing an FHA to FHA or a VA to a VA. Those are streamlines, but you don't see a lot of those.
So everything pretty much stays the same. What about cash out refinance?
Same credit score requirement.
Same credit score requirement.
Yeah, the cash out conventional mortgages, the rates are a little higher than, say, a purchase mortgage.
Do you want to explain cash out refinance?
Cash out refi is someone owns a house and wants to pull cash out of it, and so they get a mortgage. They may pay off their existing mortgage and just add cash to it, or it may be a house they owned outright and they just want to put some debt on it.
So it's like kind of like liquidating some of the cash that you have
Correct.
on the cash.
Tapping into the equity in your house with a new first mortgage.
All right, I guess that was the answer.
Yeah, I think we answered a whole lot of questions. I'm not sure if one of them was yours or not, but hopefully.
Hopefully we got those answers. I mean, we're getting a lot of likes now, so.
There you go. Got it. One of them was right. You know, a lot of people come to me when they've had some past credit issues and maybe they've already gotten some advice somewhere. It's not always right. And so I wanted to spell out some things, just some good things to keep in mind when you have someone, or maybe if you have like a average credit score that you're trying to keep at that level, or maybe you're trying to get to the next level and you make certain adjustments to your credit thinking it's going to help. So it's pretty common knowledge, I guess, that you don't close out credit cards when you pay them off, right? So if you're looking to improve your score and you're going to pay off debt, one of the scoring mechanisms of credit is how long accounts have been open. And so when you pay off credit, length and depth of credit is really important for scoring. So when you pay things off, you want to leave the revolving accounts open.
I heard it was a certain percentage you want to keep it open. So
you want to have no higher than 35% of the available credit outstanding. So if you have a $10,000 credit card, you want to pay something down to maybe $3,500, and then if you pay it down below 20%, it helps your score even more.
Okay.
So it's 35 and 20. Okay. So if you, we have a program on our side, like let's say someone has a 660 credit score, and we're trying to get them to 680. We can run it through a simulator, and it'll say you need to pay, your city card down by $5,000. You need to, and one of the suggestions it'll say is you need to move a balance from this card that's at 40% to this other card that has no balance. So you're just moving the debt around versus paying it off, and it'll, by keeping your overall credit limits below the magic number, 35%, it has the same effect.
Gotcha.
And so it's interesting, sometimes just by reshuffling balances versus paying them off, you can have the desired outcome on the score.
Yeah. Now, even on the way here, actually, I heard a commercial for like fix your credit score. Do those actually work?
Yeah. So those services, like if you have a lot of outstanding collections and maybe judgments and past dues, there's companies that you'll pay a monthly fee to, and they'll just dispute everything on your credit.
Okay.
Yes, you can do it yourself. A lot of times it's good for people to pay someone to do it because it holds them accountable. Because when someone's doing it for you, you start getting letters in the mail and you have to take all that stuff and every month send it to the people helping your credit to see what came off and what they need to keep disputing. A lot of times when you have people who have a history of past dues on their credit, it's because they've been bad at paying things, and it's good to have some skin in the game, in my opinion, and have a third party that you're paying that's doing work for you to really hold you accountable and make sure that you're going to do what needs to be done. If you're paying money, it's like if you're paying a personal trainer, you could go to the gym, but if you're paying a trainer, you're going to go. Yeah. So
I did that.
I think it's a good idea.
The only way I went running is I paid.
Right? So it's not a bad idea to pay a company if they're reputable. And that's not always so easy.
Right.
So if it's getting rid of stuff, sometimes it's just consistency in sending letters to those creditors over time. They have a certain amount of time to respond to the disputes, or the information has to come off by law. If it's past dues, legitimate past dues, you can negotiate those past dues.
Are we talking about a month or 2 months, or someone just didn't repay their credit card for like a year?
Let's say that someone just didn't pay back anything, and they've got all kinds of things in collection and in past dues.
Yeah.
It oftentimes takes money to fix that stuff.
Yeah.
You've got to negotiate settlements. One of the things that I run into all the time are people have collections, and so they think they've got these 3-year-old collections, and that's an anchor on their credit score. So if they pay off those collections, that's going to fix the issue.
Right.
Right?
Doesn't always work that way.
Totally incorrect. Yeah, because what happens is, if you have something on your credit that's old, that's in collection, the damage is already done on your credit report. When you go pay that off, initially it's going to show up as a recent event. And so a trade line on your credit report that hasn't had activity in 3 years, now all of a sudden is going to have recent activity. And even though that collection's gone, you're still going to have a drop initially. I see it all the time in your score. So usually it's best, if you have things in collection that are old, that have already done damage on your credit, to call the creditor and try to get the stuff deleted.
Call the creditor, like call FICO?
Call the collection agency.
Oh, the collection agency.
So if someone,
can you call FICO?
Right?
Hey, can you fix my credit, please?
So like if you've got some kind of outstanding collection, you can oftentimes call that collection agency and say, look, we'll give you 50 cents on the dollar, but you have to remove this from my credit history completely. And it's not easy to do, but that's the only way it's really going to improve your score immediately.
Gotcha. Otherwise, how long does it take to improve it?
It can take a while. It can take 6 months, a year from the time. If you do pay off your collections, immediately it'll drop. Eventually it'll come back up. By the time it gets to me, it's usually because someone has a house already they're trying to buy.
Right.
And so I have to find a magic bullet.
Gotcha. So if you're looking to buy something, you should, and you know your credit isn't the best, you should start fixing that within a year.
Early.
Go ahead.
Go ahead. No, you go ahead.
Oh, I was going to say, talking about fixing that within a year, what are other things you could do within that year or not do, the do's and don'ts of you're thinking about buying, but you know you have to work on some things. What are some things you should do? What are some things you shouldn't do? So
the first thing you want to do is have someone look at your credit report and see if the score is where it needs to be to get, the best type of financing.
And we said the lowest, probably 580. You can still
580 with a minimum down payment.
Gotcha.
620 for conventional, but if you're above 580, you can get financing with a minimum down payment, generally speaking. Right. So if you're not there and you need to get there quickly, we want to look at the credit report. We want to see if there's debts that we can just strategically pay down. That's the easiest. If you got some extended credit cards, we run our simulator. We see if we pay down, a couple grand worth of credit card debt to get a few different trade lines under that 35% of the available credit. That'll generally get you to the next credit level.
What are the different levels? I know 700 obviously is really good.
Yeah,
650 is good.
So FHA is usually, it's 580 to 620, and then 620 to 660, and then 660 and above.
Oh, okay.
Conventional works a little differently. Conventional financing above 620 is usually every 20 points is a slightly different level.
Okay.
And then there's another component, which is how much you're putting down. So if you're putting down, say, 40%, the rates don't really vary from score to score because you've already put down so much.
Yeah.
If you're doing maybe like 5 or 10% down, the scores matter quite a bit more.
Yeah.
And so it's all relative. Generally, if someone has a lower score, they're also not putting down that much.
Right.
So,
that makes sense.
Yeah. So you really want to get the score as high as possible. Also, when someone's score is low, generally speaking, they don't have so much money to fix their credit. So they need that money,
right.
For the down payment.
Right.
So it's not always the easiest thing. So the things you can do without money, if you need a little bit higher score, are you can look at your score and see if there's any erroneous stuff on your report. Perhaps some old collections that aren't yours, some past dues that aren't legitimate, some late payments that were marked late that aren't legitimate, and you can try to call creditors, negotiate deletions, dispute things, put everything into dispute, and try to get rid of some things that may come off on their own. I mean, it does take some diligence, and it could take some time. But if you're not fortunate enough to have a couple, $3, $5 grand, $10 grand, whatever it is, discretionary just to fix your credit and still be able to save for a down payment, there's only so much you can do.
Right.
And so you definitely don't want to close out any credit accounts, right? Revolving accounts, keep them open.
35% and 20%.
Try to keep them under 35%, under 20%. Something that doesn't take money that can build credit is, because a lot of times credit is low because you had a history of bad credit, but you have no new positive credit. So one of the things that you can do is, because you need new positive credit to water down some of the negative old stuff, right? So if you've never opened up new credit since the old stuff, the only thing you're going to have is old bad credit. So,
but you've paid down that credit.
Well, just more generally speaking, like if you had let's say 3 years ago you had bad credit,
right?
You fixed a lot of stuff, but then you were so scared that you ripped up all your credit cards, right? Which is very common,
right?
Well, your credit is still not going to be great because you never rebuilt any new credit. You only fixed some of the old stuff. So a lot of banks will let you open up what's called a secured credit card.
Oh.
You can go in the bank, open up an account, you put in $300, $500 into an account. They'll give you a secured card that will report to your credit. So it's backed by the money in the account.
Okay.
So you open up 2 or 3 of those at 2 or 3 different banks, and now you have a couple of new credit accounts. You use one of them at Publix, one of them at a gas station, have it on auto pay, report for 3 to 6 months. That'll build new credit.
That's awesome.
Right? And that's a way that you can do that. That's an immediate spike to the credit score after a couple months of reporting.
That's cool.
Yeah. It's a trick that we use all the time.
I also heard, because I even assumed, okay, well, I have a few extra $100. Let me just throw this into one credit card this month, and then next month I'll just pay the minimum. But then somebody told me, oh, well, you should be paying every month. Like, as long as you're paying every month, that's what helps your credit score. It doesn't really affect you if you add a few extra $100 into one credit score 1 month. Is that true? Does that make sense?
I mean, if we're talking about just scores and not reality, like if we're just talking about how do you get the most positive
score, yeah.
Yeah, I mean, you need to have a positive payment history. If you're paying down that extra $50 or $100 isn't getting you anywhere close to the 35% number.
Well, yeah, then you're going to want to throw in some extra money.
Paying on time is going to definitely build positive credit. But to get, in reality, the credit cards are just paying interest. And so, you do want to pay them down, not just for the sake of having a higher score.
So it's kind of a little bit of both.
Yeah, so it depends on what you're looking for. If you're looking to get out of debt, then yes, you just keep paying extra. If you're looking to just build your credit and save money for when you buy a house, clearly
you should pay it on time every month.
Just pay it on time. Set it and forget it. Auto pay. If you've got money though that you're saving up to pay down debt, you look at your statements, you see where you have the highest interest rates. You start with those. You work those down. There's a lot of credit card companies that offer you really attractive incentives to do some balance transfers, and maybe that's an easier way to get out of debt faster because now you've got less of an interest payment required. It's more principal, right?
But if your credit isn't that well, how can you do a balance transfer? Let's say you have somebody with the 580 credit score.
Yeah, so like
can they still do a balance transfer?
Probably not. But if it's someone that, like you said, is just looking to see where they should put their money, or
gotcha.
Yeah, it's all relevant. It's all subjective. Yeah, exactly. But yeah, those are certain things. The most important thing to do is when a client is thinking about buying a property, or when it's just sort of an idea. Someone contacts you, their lease is ending in 6 months, or someone's thinking about selling and then buying again. It's always important to get the credit pulled up front. I can't tell you how many times I run someone's credit, tell me their score is 800 because Credit Karma told them so. I look at it and it's like 680.
Is
all the time.
Credit Karma not a reliable source?
Credit Karma gives you a good trend. Like if you want to know, like let's say you just paid stuff down and you want to know when it's actually impacting your score, it'll tell you. You'll see the score go up, but it's not a really good indicator of mortgage credit scores because it's a different scoring model.
Interesting.
So Credit Karma is never the same, for better or for worse. I've had people tell me their score on Credit Karma is 720 and I pulled it in as 800. I've had people tell me their Credit Karma is 800 and I pulled it in at 680. It's never right, but it's always so.
Credit Karma gives you an idea.
I think it's a very good idea when you know you're going to be buying something in 6 months or less to have a mortgage credit run pulled, so that if you need to strategically implement any of these strategies, you can do it, and you get ahead of it. That's not reality often.
Yeah.
Right? Like people fall in love with a house, they want to buy a house that second.
Yeah.
So a lot of times, like, we need to get someone from 715 to 720 because they're in contract. How are we going to do that?
We're going to
look at their credit and we're going to say, we ran the simulator, you need to pay down your city card by $800, and we're going to do a rapid rescore. If we have time, it's always better, but we don't always have that luxury.
It's always good to do your due diligence early, and your homework early. So if you're thinking about buying, start looking into your credit score, get your, what did we say the rule of twos last time? Two
W-2s, two pay stubs, 2 tax returns. Yep. And if you've ever had a bankruptcy, short sale, foreclosure that doesn't disqualify you, you just need to know the rules and the waiting periods for the type of financing you're doing, which again is just a consultation with a mortgage person who can get you on the right path.
Cool. Is there anything else that they should know about improving their credit score if they're buying a house?
Not at the moment.
Covered everything on your credit score.
But if you have any specific questions, I'm always available.
Comment below.
Thank you.
And next week, we will be talking about waiting periods for loans and bankruptcy.
Next week, we'll be going over some specific, next week we'll be talking about how to get into places where if you're carrying 2 houses, some of the things you can do. And we'll be talking about some lower down payment loans, both conventional and jumbo. We'll talk about some of the creative strategies we do when someone's potentially has deals overlapping. We run into that a lot when buyers don't want to, or rather sellers don't want to accept deals contingent on the sale.
Cool. If there's anything else you want to know about mortgages, or you're looking to buy a home and you want to know some more information, just comment your questions below and we'll be sure to answer those. Or next week going live, be sure to comment in like Dave Searle did today, and we'll answer it as we're talking. Otherwise, we might be at our new central location for our interview next week, or in 2 weeks. CrossCountry Conversations is every 2 weeks. If not, come by to the new central location at 2300 Glades Road. Will you be there for a champagne toast tomorrow at 2 p.m.?
Yes.
Cool. We're having a champagne toast if you'd like to see our new office tomorrow at 2 p.m. and see all the room we have for all the agents and any new agents. And CrossCountry is going to be there as well to answer any mortgage questions. Otherwise, have a great weekend, everybody. Bye.